This is Scott Becker with the Becker Private Equity and Business Podcast. We come to you daily with interviews with brilliant private equity leaders, brilliant business leaders. We try and make sure that you come away a little bit inspired, that you learn something, hopefully that you're entertained some. We're thrilled today to be joined by a brilliant leader, Mitchel Nakken. And Mitchel's a leader at Palm Tree. He's going to talk to us about what they do, how he got into it, and we'll talk about trends, about where he's focused, and a lot more. Mitchel, can you take a moment and introduce yourself and tell us about Palm Tree?
Yeah, Scott, thanks for having me. Appreciate it. Excited to be a part of the podcast. Yeah, Mitchel Nakken. I'm the Senior Managing Director and Co-Head of Consulting at Palm Tree. Palm Tree is a full-service M&A advisory practice, and we combine investment banking with financial and operational consulting services, both pre and post-close for mainly private equity-owned businesses on the consulting side and founder-owned and private equity-owned businesses on the investment banking side.
Thank you. And talk to us about sort of the business right now, the private equity deal making environment. From what I could see is the large funds are back at it with the vengeance. A lot of founders that have been waiting on exit are sort of excited to sort of look at the options in the market and so forth. And the mid-market funds are starting to get back after it. What's your sense of market trends and what you're watching currently, Mitchel?
Yeah, I'm watching a lot of different trends actually right now. As you think about what we do at Palm Tree, one is just pure play founder-led M&A activity, right? And that has been largely on the sideline for the past, we'll call it year and a half or so. However, if you have a high growth, highly profitable, well sought after industry, an asset in one of those industries, we're finding that those deals are still happening at a pretty normal clip and at relatively high valuations. Those businesses, however, are just fewer and further between, given the economic performance we've experienced over the past, especially the past year, maybe the tail end of last year. But on the at the large scale of things, we're watching a lot of corporate carve-outs, a lot of multi-unit mergers are happening at once. These very highly complex, heavy post-close operational intensive transactions. You see a lot of the sponsors that look for those types of opportunities to be highly active right now. And you're right, in the middle market, we're starting to see some uptick in activity. And inside of our suite of services, we have a transaction advisory practice that is starting to see quite a bit of inbound deal activity, which we always say is really a leading indicator, given that most of their work is on the sell side or the buy side. We're watching those opportunities come back to life and hopefully signaling for a fairly hot start to next year from an M&A closing perspective.
And you had mentioned that certain industries, certain areas are really in a lot of demand. Where are those industries? What industries are you sort of most excited about? Where do you see more energy than others?
We're seeing a lot, honestly, in the engineering services space. And we don't do too terribly a lot of this. We have some experience in this space, but if you think about any type of government-backed infrastructure expenditures or type of environmental improvement type efforts, we're seeing a lot of activity in those spaces. We've watched, of course, asset light and distribution had been one of the hotter sectors. We've seen that cool off a bit. We've watched CPG cool off a bit. We've watched the SaaS industry, all of those software providers have an exceptional run and then quite the clawback as growth became more expensive, right? But when you think about the deals that we have watched get transacted for some of our client base, we've got food businesses, we've got textiles manufacturers, and there really isn't one cadence related to another. We're watching roll-up strategies in residential services be very, very popular still, and really down the chain of services, right? We watched roofing businesses be the hot commodity. Now we're watching folks talk about overhead door businesses and paving businesses. And so there's still a large component of predictable revenue stream, profitable business, profitable operational business that is relatively simple and asset light tends to still be one that gets a lot of attraction from the private equity buyer universe.
And are a lot of those businesses mom and pop businesses, or they're already somewhat organized beyond that? What do some of those look like? So we see it here where there's Feldco windows in Chicago, for example. They were bought by a family, then that family's grown it like crazy, so it's no longer sort of feels like a mom and pop business, though maybe it still is a family business. What do you see out there? Are they sort of are they those residential services businesses? An example, we saw the HVACs roll up some. What's the
I,
size of those things? Are some of them franchised? What do those look like?
I think by and large, you're watching a lot of them start much smaller than normal, even in the middle market, right? There's a relative appetite now to start much smaller from an initial platform basis. One, I think it's easier to get those deals done in the current lending environment. But two, you have a real opportunity for value creation right out of the gate from a multiple perspective, right? If you can scale a $3 million EBITDA business to 15 to 20 to 25 million in short order through M&A, there's a significant multiple expansion opportunity just on the scale alone, whether you integrate or do any type of operational improvements with those add-ons, right? And so that's
I mean,
that's where we're seeing people focus.
in there, it's almost like the old days of going from a 7 to 8 multiple to a 12 to 14 multiple, just based on making a bigger, more substantial business that's maybe less fragile to any one particular executive or leader or customer.
That's right. And we're seeing an interesting development on the financial side. If I talk about what we see on the financial consulting side of our business is we're watching because of the extension to the diligence portions of the transaction phase and the microscope being turned up a notch or two because of this, tighter lending environment. Everything costs more now, right? They're just far less, we'll call it opportunity for mistakes. And so we're watching businesses go through transactions that normally would have traded, having not really done a ton of consolidation work, especially on the financial side, inside the businesses themselves. And we're seeing that the buyer universe at certain scale moments, 25 million of EBITDA, 30 million of EBITDA, 40 million of EBITDA, the buyer universe for those businesses don't have the appetite to take on a major finance transformation. And so we're watching the lower middle market or the middle market shops try to invest deeper into that consolidation and try to do most of that work up front to set that platform up for real scale down the line.
And are you seeing in these transactions a different amount of equity versus debt in transactions? I know on the VC side, it's always been almost all equity, but in the mid-market deals, the larger deals, what's that mix of debt versus equity that you're seeing? Has that changed some over the last several years?
I think it has changed a bit. I can't speak too closely to it. I'd have to check with some of our TAS professionals to let you know what some of those sources and uses have looked like lately. Generally speaking, though, what I've heard has been a bit more lean on over equitizing the transactions, mainly because of the lending environment they just had less of an appetite for the large multiples of EBITDA from a leverage perspective post close. And because of the uncertain economic terms, the buyer universe is taking a little more conservative approach so that they don't have to, worry about covenant compliance or liquidity issues post close in those first 3 to 6 months of ownership. Because the lending community gets, very upset when those things happen immediately post close.
Mitchell, what I've seen over the years is really, and you've had this exemplary career, and I want to come back to that in a second because there's so much there. But you came out of Michigan State. I'm a Midwesterner. We've seen so much success out of Michigan State entrepreneurs, advisors, finance leaders, and so forth. We happen to spend time with the Shore Capital Group, Justin Ishby and team, who are also wonderful Michigan State grads. Is there a reason why it seems like Michigan State and grads and finance folks have outperformed, where people might have expected or compared to some of the other Big Ten universities or even Ivy League universities? Why has there been so much success in the business community out of that university?
Yeah, I'm happy to speak to my experience, but you mentioned the Ishbias. I mean, I absolutely think the world of of that family. They've done quite a bit for both of their home states and my university. And And the Shore Capital team in particular, a firm that I think is really exceptional in the mid-market space for private equity. So absolutely agree with you there. And as I speak to my experience coming out of Michigan State, there was really a few items that we had to focus on. And I was an investment banker by trade to begin with, and we were not a target school for any of the major investment banking businesses on the West Coast, East Coast, in Chicago. We had to kind of use our network and our technical acumen to set ourselves apart in those interview processes. And so we focused heavily on the technical piece inside the education, inside the four walls of the university, and then use that vast, exceptionally large alumni base to network our way into various opportunities and then subsequently reciprocate that network backwards as graduating classes left and joined the financial markets. On top of that, I think for myself personally, I was always raised with a pretty decent work ethic, and I think a lot of the folks coming out of maybe Michigan State, having not been a target school or not, heavily recruited, had a pretty sizable chip on their shoulders that wanted to go out and prove and work harder than the next person and earn that opportunity for themselves.
Well, and it's one of the reasons why certain schools, whether it's Texas A&M, Notre Dame, Michigan State, Illinois, have had this great reputation amongst employers, amongst companies that want to hire consultants and banks and others for doing just getting what you pay for, doing great workman-like jobs in a very bright, resourceful type of way. And I'd say work person-like jobs. But really a fascinating thing to see schools outperform in certain areas like Michigan State has. Talk for a second about this, Mitchell. You spent 10 years at your first job, and that to me is just, I love people that aren't job hopping constantly. Talk about that and the experience that people gain in spending serious amounts of time at a job, at a place, and how they grow and learn. Give us a moment on that if you're okay with that.
Yeah, absolutely. I would have stayed at my first job much longer than I did had I not had the opportunity to effectively join a startup in the area. And back in those days, there was a really large contingent of my friend network that were joining startups, starting their own businesses, being very entrepreneurial. And I think I've always had, I'll joke that I'm not maybe the entrepreneur, as I've never started my own business. But I am like the second person to jump in the boat with the entrepreneur. And for me, the opportunity to go in a relatively unstructured environment to go and create something with a group of folks doing, and more importantly for junior team members out there, doing more earlier on in your career in that doesn't work for everybody, but in a relatively unstructured environment creates a lot of opportunistic learning, a lot of opportunity to be resourceful, a lot of opportunity to get exposure to senior levels of other organizations faster. And the key is are you absorbing those experiences, learning from them, adapting your approach to be prepared for that next experience? And then I'll bring up the networking item again. Is there was a heavy focus at that firm as a relative unknown in the industry to go out and help build a network or a brand inside of a very large space of investment banking and consulting. And that's effectively what I was able to do there, which was basically create a consulting group inside of that firm and really try to scale it and grow it.
When you're working with founders of businesses, talk for a moment. Is there a typical profile, or do entrepreneurs and founders come in all different shapes and sizes? And what excites you about working with founders who are looking at doing something with their business?
I would say they're all a bit different, but share similar characteristics. And I think the visionary aspect of the founder community is exceptional, and one I have intense admiration for because of the fact that I stated previously, right, where I was, number two on the boat, right, but behind a founder with a good vision and helping shape and drive that vision. And so I think from my perspective, it is that stick-to-itiveness to the vision, the belief in that vision, the ability to adapt when need be, but to, a lot of times founders are hearing all the naysayers, telling them what they should and shouldn't be doing, and what's going to work and what isn't going to work. And they have we'll call it the risk appetite to go after it and continue to pursue it in the face of any of those obstacles that may or may not present. And that is a core fundamental thing I see with every founder I've ever encountered.
Right. That core effort on relentlessness and diligence and going after things and really that determination, right, to be successful.
Determination, belief, and then overall vision for what the art of the possible is, even if it's not overtly clear of what could be or what might have been with whatever that business was that they started.
And talk about that determination and that art of the possible, because not much could describe better the great investment bankers like yourself that I've seen over the years that have that determination, that art of the possible, understanding the entire dynamic, the environment, what works, what doesn't work, and the ability to tell, clients, hey, we're just not going to be able to do that right now, or we are going to be able to do that now, and here's how we should approach it. Talk about the core qualities of a great banker.
Yeah, I'll speak for I won't speak for our investment bankers, but I will speak for myself as the leader of the consulting group and a former banker. And we share the same vision across the leadership team. Our job is to provide exceptional advice, whether that advice is hard to hear or that advice is what they were hoping to hear. And you'll never find someone from Palm Tree, try to win, let's say, a pitch or a mandate based on a false pretense of value, or in my case, on the consulting side, what it may or may not take to get the business to what they deem to be a successful outcome or a best in class operating portion of that company. We are going to be as upfront and honest as possible and give real reads on the situation at hand, even if that information is in some cases tough to digest or hard to hear. The key is can we message it in a manner that we can still be productive and help achieve the goal ultimately, without ruffling those feathers, right? We consider that velvet glove treatment to the way we communicate is very important, but the message doesn't change.
Thank you. And in the consulting practice, when you talk about the core of your consulting practice, take a moment there and just give our listeners a better sense of the core of Palm Tree's consulting efforts.
Our consulting services is really spans two categories, and one is relatively newer, and one is what I would call our core or the legacy business at Palm Tree, and it's office of the CFO as the legacy and core to the business, and that goes across pre and post close. So transaction advisory services, which quality of earnings, or post close working capital, opening balance sheet, those types of exercises you do around transaction accounting. And then we have accounting advisory, strategic finance, and data and analytics as service offerings to professionalize and transform the office of the CFO. And then over the course of the last year and a half, with astute leadership from our head of that practice, have been incubating an operations consulting practice inside of Palm Tree by organically developing not only the talent, but the frameworks and the engagement reps driven by customer demand, where we were able to announce to the market in August of this year that we had a fully built out operations practice that was largely, extremely busy at that time. We did not announce to the market that we were doing it before we actually had proper amounts of work, structure, and talent to support the ask from the marketplace.
Thank you very, very much. And let me ask you one final question. When you look at this coming year, Mitchel, what are you most focused on and excited about?
I'm very focused and excited on integrating that operations platform into what Palm Tree's consulting unit does today, and then harmonizing across investment banking, consulting for our private equity clients, right? I think of us as a true extension of the private equity community because we can effectuate transactions, raise capital, advise on the transaction itself, opine on the operations of the business, help de-risk the asset post-close, and then ultimately transform the asset during the hold period and maximize enterprise value for the companies on an exit. And so really staying with the life cycle of the business, which we were maybe not functionally set up to do about a year and a half ago, we now have that ability to do that across all of our service lines. And then watching that M&A trends that we talked about earlier is very important too, because as those shift and the market gets hotter, we want to make sure that we're managing our resources effectively so that we're bringing all of the top talent to our client base.
Mitchel Nakken of Palm Tree, Senior Managing Director. Thank you so much for joining us today on the Becker Private Equity and Business Podcast. Just phenomenal. Thank you very much for joining us.
Scott, thank you for having me. This has been great.